Mark, thank you very much for being interviewed as part of this conference hosted by the Monetary Authority of Singapore and supported by Gfanz. Mark Carney is co-chair of Gfanz and also the UN Special Envoy for Climate Action and Finance. Mark was previously the governor of the Bank of England, and prior to that, the governor of the Bank of Canada, and has held a number of international roles, which I won't go into, but that includes being the chair of the Financial Stability Board. So Mark, thank you very much for being with us. And maybe before we go right into the interview, just a word on Gfanz. So Gfanz was launched under your leadership last year in April and amalgamated a very large number of financial institutions representing a very large value of financial assets. Maybe just very briefly, where is Gfanz now in terms of presence, shape, and geographic representation? And then we'll go into the interview.
Cindy, just to give a bit of background on Gfanz, as you said, we launched Gfanz originally at President Biden's climate summit in April, which really was the U.S.'s effort to kickstart and accelerate climate action into the Glasgow summit. The intention was to build Gfanz, which at the time of President Biden's summit was around $30 trillion of assets, was to build it into Glasgow and really span the waterfront of financial institutions, so banks, insurers, asset managers, asset owners, as well as the key providers of financial market infrastructure, ultimately export credit agencies, others, so that all aspect of types of finance, is not just scale, but breadth of finance, was focused on developing the tools, the frameworks, the markets, so that the financial system could provide capital to get emissions down, to get the world on the path to 1.5 degrees. At Glasgow, we launched with about 450 institutions. It's over 500 now. It was about 45 countries. It's almost 50 countries now that those institutions are headquartered in. And even though, unfortunately, most variables and measurements in the financial system have been going down over the course of the last several months, the assets of Gfanz have still exceed now $130 trillion. So if you combine the balance sheets of those entities, and I think the important thing to recognize is, and I'll just reinforce, is it's a commitment of these institutions. They all have commitments, not just that their financed emissions, so the emissions of their clients and their investments, will be at net zero by 2050, but bringing that forward, that they will contribute to the fair share of the almost 50% emission reduction that the world needs to accomplish by 2030. And in addition, particularly for the banks, to have 5-year decarbonization plans, net zero plans, that we'll get into that in our discussion, as well as annual reporting of those financed emissions. So the future is brought to the present. And really what's happening now is, of course, we're looking to grow Gfanz, as you would expect. We are very focused on making sure that it is tailored to different regions. I'm sure we'll get into that. But as well, turning these commitments into action, and that requires a series of measures to operationalize those commitments. This hasn't been done before, and it needs to be done rapidly.
So let's turn now to the Gfanz master plan at this moment in time. There were a suite of publications released recently. They covered sectoral pathways. They covered guidance for transition planning for financial institutions. They covered portfolio alignment measurement. They covered managed phase out as a net zero tool. Just share with us, how do these fit together, and what is the Gfanz master plan at this moment in time?
The premise of your question is absolutely right. This all fits together. If we didn't have the component parts, it wouldn't work as effectively. The sum is greater than the components. But let's start with what's necessary. Well, these financial institutions, these members of Gfanz, have made a commitment that they will manage their financed emissions, in other words, the emissions of their clients, their investments. They'll manage them towards a pathway and then ultimately on a pathway consistent with the world limiting global warming to 1.5 degrees. So those financial institutions need plans themselves. They need net zero transition plans themselves. There are very different types of financial institutions in Gfanz, from banks to asset owners, insurers, everybody in between. We want to have a common level to those plans. So the type of information, the type of governance, the mechanics of those plans, so that they're consistent and they can be compared by all stakeholders. That's the first point. But of course, finance is not an end in itself. It exists to serve others. Those others are in the real economy, we'd like to call the real economy, so real companies, real governments. And the question is, what do financial institutions who are committing to try to manage their clients' emissions towards net zero, what do they want of those companies? And can we be consistent across financial institutions of the ask of companies? And in many ways, this is the transition plan analog of the TCFD, the Task Force for Climate-Related Financial Disclosures, where the focus of the TCFD, when it was developed, was being developed seven years ago is when it started, was to focus in on so-called decision useful information. So the information that was necessary to make judgments in that case about climate risk, but no more than that, so that it's an efficient process and it's an effective process. It's the same thing with the asks of company transition plans and making it consistent across the financial institution. Okay. Third point, which you rightly reference, sectoral pathways. So what this means is, and many people in the audience will be familiar with and probably use things like science-based targets for certain sectors, the steel sector, certain elements of the transportation sector, for example. And the key point here is we need to have some consensus about how to use those pathways. Gfanz is not reinventing these pathways. We're letting the experts provide those pathways, but providing guidance on how to use them. Next point is around managed phase-out. We're all aware that if we're going to get to net zero consistent with that 1.5 degree objective, there will be substantial stranded assets. We see it most obviously in fossil fuel generation such as coal, but there will be other examples of that. And the issue is that we need a system and an approach, a framework, so that those responsible financial institutions, those, if I can put it shorthand, those members of Gfanz who are looking to be part of the solution, that they can finance the wind down of those assets. In other words, keep those assets in the system where there's scrutiny, where there are guardrails, there are those sectoral pathways in terms of the speed with which those assets are phased out, and there's financing that can help support a just transition. So that is also developed. And then my last point, and the last element of this framework, is a way to bring all the component parts together, which is to do an assessment of what's called portfolio alignment. Because ultimately, whether you're a bank, an insurance company, an asset owner, asset manager, you're looking, or you should be judged over time at to what extent is your financing portfolio aligned with the transition to 1.5 degrees.
Sectoral pathways, they're meant to be the bridge between the science and then the industrial action that every sector should be taking to decarbonize. How are they working in practice? And in particular, sectors are not equal around the world. And the sectoral pathway, the natural sectoral pathway in Asia, for example, where this conference is being held, might have further challenges. Could you talk about the application of sectoral pathways, in particular in Asia?
I think it's a great question. And the first thing is to, again, acknowledge the point you're making in the question, which is not all sectoral pathways are the same. There are regional differences. There are differences in terms of starting positions, and they need to be recognized. And if they are recognized, then the incentives are aligned so that finance will flow to actions that are being taken in different parts of the world, in this case Asia, that are consistent with what needs to happen at the pace that it can in this jurisdiction. That's the first point to make. The second point to make is we should all recognize that there are some sectors that are not yet covered or are covered to different degrees by sectoral pathways. Let me explain. In some of the hard to emit sectors, there are quite detailed or science-based sectoral pathways by people such as the Transition Pathway Initiative or SBTI, etc. But in other industries, for example, the oil and gas sector, there's actually not one of those pathways. We have higher level macroeconomic sectoral pathways that are driven by the carbon budget, not by the technological frontier. And it's important to map those into pathways that can be used by the financial sector. It's clearly absolutely fundamental and critical. And one of the things Gfanz is doing, and will come out in a few weeks' time, will be to publish some initial guidance. It won't be the final word by any stretch of the imagination. Initial guidance around these issues in order to help develop a consensus there. The third thing I'd say, and this starts to get to the Asia question, is there are opportunities to improve these sectoral pathways. As I say, there's a variety out there. I'm going to try to group them around D's. Definitions. We need to standardize and clarify the definitions that the different pathways developers use for assumptions on carbon pricing or emissions covered. Secondly, around dependencies, we need greater clarity about to what extent is decarbonization in a certain sector dependent on other sectors, and very often that is the case. Thirdly, data, access to underlying data and assumptions used for the pathway is critical, obviously. And then the last one I'd flag is, and it's not perfect, my D, but detail, which is this big issue, which is to have additional granularity across pathways to cover time intervals and regions with respect to Asia, potentially more broadly, and we may come into more detail on this. The so-called JETP partnerships that some countries will pursue can play a very important role here, particularly in the energy sector, as the name suggests, Just Energy Transition Partnership, particularly in the energy sector in terms of what is the right pathway for the transition in, for example, Indonesia or Vietnam or other countries.
What do you see now as the real challenges for financial institutions? How ambitious should they be with these transition plans?
Now, of course, there will be, as there always is, there'll be leaders in every sector, and in some cases, companies, some global companies have been out in front on this. They've been SBTI signatories for a few years, or they've been part of Mission Possible initiatives or other major initiatives that meant they've got a head start. But more, even they can do better, and more broadly, people need to move. So the first challenge is the fundamental one, which is getting companies moving on this. And this is why, in our judgment, this overall initiative is so important around what you were calling the master plan. We hadn't quite termed it that, but clarifying the expectations of the financial sector of companies, getting everyone on the same page, and then making sure this process is as efficient as possible. I think a second issue that has been an issue, and it's critical that we nail it, is being absolutely clear about what we mean collectively about transition finance. There are, in our judgment, in order to decarbonize, there are four strategies here. There's clearly climate solutions, whether it's clean energy or things that enable clean energy. There are entities or assets that are already aligned to that 1.5 degree pathway. Critically, there are those entities and assets that are transitioning or aligning with that 1.5 degree pathway. In other words, they don't just have a plan, they have access to finance, and they have a credible prospect of implementing that plan. And if they implement that plan, they'll be aligned with the pathway. And then lastly, what we just spoke about, there's the accelerated and managed phase out of high emitting assets. So making sure, and this is my sort of second issue, which is making sure that financial institutions understand all of those strategies. Obviously, it's for them to choose which ones they put greater weight on, but then execute against that.
And you've spoken about what a reliable financial institution financier should be doing around this agenda. What about the NGOs and the policymakers? What would Gfanz like to see from those communities to support both managed phase out and at scale transition finance?
Well, I think the first thing is well, there's several contributions. The first, from a policymaker perspective, and interrogated, if you will, or examined by NGOs. We need these credible energy transitions that are consistent with the climate goals, which have a just transition component to it, and the policy making framework for those is essential, and that includes support for workers and communities, but very much includes the fundamental enabling environment for the investment, the generic enabling environment, but also the very specific economics and incentives of, for example, in the power sector, both positive incentives for cleaner energy and punitive incentives for the existing fossil fuel that obviously build over time. So that's the first thing. The second, one of the roles for philanthropic capital and official capital, whether it's domestic or foreign, is in many cases to help build the capacity in economies for the types of financing that's required. And some of the most catalytic financing, as you know, in a number of countries is in basically financing project preparation. It's relatively small dollars to the overall amount of the financing that's required for multiple gigawatts of clean energy, but it's essential because it is a risky part of the process, and it really can unlock broader financing. So there's definitely a role for concessional and philanthropic capital there. And I guess the last big thing I'd highlight for policymakers is around financial sector policy and standards. There's been a huge number of financial institutions from around the world that have input to the development. We had a public consultation, over 1,000 submissions to it, and various ways that's the recommendations being incorporated. But ultimately, these are voluntary approaches, and the experience I would suggest with climate disclosure and other critical standards for financial institutions, financial markets, is that ultimately we would want a mandatory approach and associated coverage.
There are two things we hear from individual banks around blended finance transactions. We hear that they're risky, and we hear that the returns are not great. So what's it going to take? Is it that banks just need to keep pushing on those landmark deals, deal after deal until there's scale? Or is there something else that needs to happen to actually get the blended finance to flow at much greater magnitudes?
Yeah, I think the first thing is that that feedback you're getting from banks and others tells us that we don't have, in many cases, the right blended finance models. And so in some cases, if they're risky, it means that the public sector is not necessarily shouldering the risks that it should. Or secondly, I just note that the the macro numbers in terms of blended finance has crowded in, quote unquote, less than $1 for each dollar of official capital, and that's not great leverage, and again suggests that the instruments need to be improved and become more effective. So what can be done about that? I think being very disciplined, and this is a charge for the providers of concessional capital, for the multilateral development banks, the development finance institutions, is what are you doing that is really scaling the flows of capital in aggregate to the emerging and developing economies that really need it and need it now. This is not something the private financial institutions can do, but I think it's a challenge to the shareholders and the donor governments. Is part of the incentive for an institution, and it is the case in some cases, but is part of your incentive structure, the aggregate amount of financing that is catalyzed. How do you measure that? Is it a performance indicator? So that's the first thing on a macro basis. I think the second issue is around, well, what are the types of activities that have the highest return, again, for overall flow? I mentioned project preparation earlier, relatively small dollars, but key dollars, and it's not often, or it's not quickly enough, money that's spent from the private sector in developing that, in part because of a related issue around quite often a series of very important technical issues around capacity and sorry, not capacity, but the enabling environment in economies. Thirdly, then becomes a question of, well, what are the instruments where the official capital, the blended component, or the official component of the blended finance, what risks are they absorbing, and do they have that catalytic impact? Is it political risk insurance? Is it an element of foreign exchange? Is it can the risks of those be appropriately diversified amongst official sector actors by pooling official finance as much as possible?
Mark, we're towards the end of the interview, but maybe just to to close with this whole architecture that Gfanz is prosecuting. If you were to just roll forward a year, what would be some of the hallmarks you'd like to see? Where would you like us to be a year from now?
A year from now, we should be in a position where the following is the case. That the bulk of Gfanz members have released their net zero transition plans. So they have the first iteration of these plans, because what's happened by the end of this year is that we have come to consensus on the components of that. And then, the institutions are working through those. It's at the end of this year. Next year, they're either releasing them or they're releasing them with their, annual reporting that comes a few months later. But that they're at that point. That's the first thing. The second is that I mentioned that net zero data utility, public data utility, that is up and running by the end of next year, and it should be up and running by the end of next year. And it's being populated initially with emissions data, then these net zero plan data for financial institutions, for companies, and a way to compare across those institutions and see consistency or not with the transition that has to happen. Thirdly, we very much want to see from the bottoms up more successful CFLI projects. So from Indonesia to Colombia, a number of countries in between. We would like to have at least one, ideally two, if not more, but concrete JET-P agreements with financing backing them up. And I guess the last thing I'd like to say, and we'll know this more with a bit of a lag, but if I had a big picture, and I'm going to grossly simplify, which is that in the run-up to COP26 in Glasgow, there was a lot of work on the plumbing of the financial system by the official sector, and there were commitments. It was moving concepts to commitments for the financial sector, from sustainability to net zero commitments. We got that. Now we've been working on operationalizing those commitments. The bulk of this discussion has been around those elements of operationalizing it. And as financial institutions are operationalizing, as companies are coming to grips with the transition, now what we want to see over the course of next year, and certainly accelerating beyond, is that that translating into action and emission reduction that can be verified, tracked, verified, and reinforced.
Thank you very much, Mark, for sharing your thoughts on the full Gfanz agenda, how it relates to some of the specific Asia opportunities and challenges. And thank you very much for participating in this conference hosted by the Monetary Authority of Singapore.
Thank you, Cindy. And again, thanks to the MAS and everyone in Singapore.